Good morning, welcome to Morning Outlook. This is Kim speaking on, Thursday, the 18th of March. So, we had the Fed meeting yesterday. We had the results coming out last night of their, or yesterday evening, of their voting, and in particularly the market was focusing on the dot plot, which was suggesting that interest rates are less likely to increase in 2023 than a lot of people were expecting. However, the markets are not fooled by this morning, and we're seeing yields flying up. In fact, if I show you the bond market here, this is the 10-year T-notes or bonds, as they're known. If we come back to the there we go, they're making fresh lows. In other words, the yields on these, the other side of the bond price is the yield. These yields are coming off, these bonds prices are coming off significantly, pushing effectively the yield up above the 1.7 area, which is as low as they've been for a long time, or as high yield wise, low in terms of price, as you can see. So what for the markets today? As I said, I don't think all traders have cottoned on to the fact that they're still going to probably be hit by inflation, and with the fiscal stimulus and everything else, that we might see even more growth and inflation potential, and hence interest rate increases sooner than the Fed are letting on at the moment. I think it was a very dovish talk last night, listening to it, and it looks like it was really trying a real balance of trying to keep the dollar weak. Anyway, doesn't look like it's going to work this morning, because we're already seeing it hasn't broken these prior highs here technically, and it doesn't look like it's going to at the moment, for at least. Before I move on to the rest of the technicals, of course, just bear in mind we've got the Bank of England meeting today. We should see news at 12 o'clock. Not expected anything surprising there. I don't even think there's I don't think that the governor is speaking afterwards either. So very unlikely to be any changes or any surprises there for sure. Okay, let's look at the technicals then, and keep focus on these technicals for a moment. So euro dollar then, if it had broken this high here, I would have been looking for further upside, and that's what I was expecting this morning at one stage, even though I didn't feel comfortable with the data that came out yesterday, but it's just me maybe. Anyway, it's looks like it's air kissed its daily 21. It's failed to break up, and at the moment we're seeing a bit of a sell-off, which looks a bit bearish for the euro. Now this might turn around, and markets may come or see a change if the bonds are starting to be bought. It may just push those yields down and comfort those traders. But for now, I do wonder if this big bearish engulfing bar will see a bit of a continuation to the downside. Okay, that's the euro. The pound is probably similar case for this morning. It has pitched up. It put it's quite a bullish look still to it. Yesterday we saw a nice move up close towards its highs there, but it's just not holding on. And when you come down the time frames, it certainly doesn't look so pretty where it's sitting at the moment. And if I just bring it down another time frame there, again we've got this sort of pretty much a bearish engulfing bar sitting here. And probably a bit of divergence. It's just marginal divergence across there as well. So looking again, that there's a possibility we can catch a continuation to the downside here. So that's what I'm looking at the moment. If they break to the downside, I will go in that direction initially anyway, even if it's back down to the lows, recent lows. Dollar yen, well, again, it didn't have a major reaction yesterday to dollar yen. We saw a bit of continuation in today's bar there, and it's popped straight back up again. And well, we could just see again a break of these prior highs here may be on the cards. I've been bullish on the dollar yen for quite some time now, and I remain that way at the moment. I think it's still got some scope to go back into those 110 area and maybe even more. Okay, it's that Aussie dollar. Well, we saw some decent jobs data coming out in the Aussie dollar, but it can't hold on to its gains this morning. I think that's really a sign of this potential weakness that's sort of sitting through there and possibly more buying of the dollar as we go through today. I might be, I'd say, maybe completely wrong, but these bars here, they just, to me, are shouting a bit. They're key reversal bars on most of these markets, and at this, as I say, okay, 8 o'clock comes, they may get just partially triggered or not triggered at all, and we may see rallies. But at the moment, it doesn't look how I really expected it to look this morning. When I was looking at it last night, I thought we might push through. Canadian dollar. So the Canadian dollar again pushing to new US dollar, Canadian dollar pushing to new lows, and the Canadian dollar remains one of the stronger pairs out there, stronger currencies out there. Bit of a reversal again at the moment, and no different here. Look, if you're looking at on this time frame, big bullish engulfing candle, key reversal candle. So we're seeing them. As I say, 60-minute time frame everywhere. Of course, just because you get one of these doesn't mean to say it's going to continue, but they do look soft at the moment. S&Ps, how the equity markets take into it? Well, they're coming off at the moment as well, and if we look through here, there's sort of certainly bearish tones at this stage, and lower high already in on the 60-minute on the S&Ps. They're still falling. These yield, as I say, these high yields not doing any good. We could see more money pumped into buying these bonds to stop the yields dropping, but increasing, beg your pardon. But I'm not too sure if that's going to really solve the problem. I think the markets just don't trust things. Gold. Quick look on the bigger picture. Gold was pushing up quite nicely yesterday and closed up sort of the highest it's been for a week or two, and it was again reversal looking bars and lower high confirmed through gold at the moment. Now, as I said, with all of these, we may not see any continuation. This may be it. This may be just a correction, and we could see just some continuing up. Albeit, if they do that, that's fine, and we got some potential, continuation patterns to the upside. Then you'd expect, people just buying on these dips may just be the reason why this just then gets a decent bounce. But as I said, I'm not overly convinced. We'll see how it runs through into 8 o'clock. Okay, let's just scroll down if I can here. I can't scroll down, it's not letting me see still. Oh, okay, can't get my chart to show me the rest of what I want it to show. Never mind, we'll have a quick look at Bitcoin. Bitcoin was doing the dance yesterday. There you go, ended up pushing up positively yesterday, but again this morning just seeing a bit of dollar strength coming through. This is, remember, this is Bitcoin US dollar, so all showing strength, or the dollar showing strength even against Bitcoin here at this stage. Okay, that's pretty much it there. So why is CAD so strong? Well, oil has been pushing up pretty well, John. So CAD has, the Canadian dollar's done pretty well from that potential, and the overall growth outlooks and things like that. I mean, it's just that where the money seems to be flowing at the moment, and it's just holding in there. High oil prices will obviously help the economy there as well. So it's a sort of a balance of all things coming together, and it's just outperforming at the moment. We'll see how well it does and how long it does that for. If yields go up, it pushes. Okay, so the question there: if yields go up, how does that affect the economy? If yields are rising, it's suggesting it is suggesting interest rates are going to be pushing up. As soon as the more or quicker interest rates push up, the more likely you'll slow down the economy, because it's obviously more expensive to borrow. From a consumer's point of view, it puts mortgage costs up. From a business's point of view, it puts their rate of borrowing up, and it just puts the brakes on a little bit. So that's really where why the economies look at these. And you've got to bear in mind, I mean, these yields, yes, they go up and down, and they're not necessarily controlled. Well, they're certainly, as you can see, they're not controlled by the Fed as they are at the moment. But they'll go up and down, but they'll put the cost of future borrowing up regardless. If I was going to lend money over 20-30 years, and I'm seeing that the potential on the actual yields, the bonds themselves, is going up, I'm thinking, well, hang on a minute, I've got to get I've got to increase the level of interest I'm going to lend you the money for. So from the get-go. So here you go. That's why it can slow down an economy. It's not meant to put the brakes on completely. It'll be to slow up a boiling economy. Normally, interest rate increases, and that's what how the governments or the central banks or the Fed, as it is, will try and adjust an economy to get the inflation figures right, so it doesn't overboil effectively. Hopefully that answers your question. But in the short term, these higher yields, as I say, are pointing to higher inflation. In turn, inflation, etc., are not good for the equity markets. Higher yields won't trigger inflation. In fact, they'll effectively slow it down. It's quite the opposite. Yeah. Okay, I wish you guys a great day. It's 8 o'clock. I want to have a good look at these markets, watch these new candles come in. Have a great day, and I'll catch you in the morning. Bye for now.